Dylan, thanks so much for your time, as always. As Skycastle, I'm interested in your view and your assessment of global markets right now. I read a headline that the Dow is set for its 12th day of losses out of 15, as you know, risk-off continues to dominate global market trades. But for you, how are you guys viewing the current market scenario, and how are you protecting your portfolios?
From a long-term protection perspective, I mean, it's been a healthy correction as it sees it so far. So in majority of your tech sectors, your stocks that have outperformed over the last 5 years, we've seen a bit of a pullback. I mean, a lot of those stocks have actually had a healthy pullback in terms of their ratings and their PEs and their forecasts, so they look pretty good.
So you're calling this huge sell-off that we have seen that's got everyone in a panic a healthy correction. Did I hear you correctly?
Correct, yes.
Okay,
yes.
okay.
So a healthy correction for now. What we are seeing is, though, we are seeing impact of this coronavirus coming through. We're seeing further GDP forecasts still to be adjusted. We're seeing earnings still to be adjusted. The full impact of what's happened hasn't come into the market yet. As it stands right now, it's healthy. It could be a buying opportunity, but over the medium term, let's call it 3 to 6 months, it will still unfold as to how bad this has affected the supply chain of US companies, and still to see how bad this virus could still slow down the US supply chain and demand within the US economy. So to position ourselves right now, it's healthy as it stands, but to still monitor the economic data and the actual impact of the underlying when they come out over the next 3 to 6 months.
What are you telling your clients around what they should be doing right now? I mean, are you seeing this as a buying opportunity, given that we have had stocks come off significantly, particularly over the past week, given the crash in the oil price, or are you telling them to hang 10 until the storm peters out?
We advised clients a couple of weeks back within the tech sector to sort of lighten up on the exposure because the valuations went to extremes and they went out of whack. They went to sort of 2008 levels valuations. So we advised trimming a portion of your tech exposure back so that you did have some cash available to get into tech if it did pull back. We have seen a bit of that money being deployed again at these levels. On an index basis, what we are looking, so the Dow, the NASDAQ and the S&P 500, we are saying to clients, look, we can be long over this week, but be very cautious. Our line in the sand, and I'll refer only to the S&P 500 because it's a chart, that's a price that you're indicating on your screens. It's effectively, the line in the sand there is around 3,000, so another 200 points higher from here, which is still 10%. And then we'll assess it again from there. But 10% higher from here means that we've only been down 10% for the year, and then we could potentially see some follow through on the downside, depending on when we get there and what numbers start coming through from an economic perspective at that stage.
So you have just explained some of the long positions that you have been taking. Talk to me about the other side of the market. Are you shorting anything right now, and if so, what?
So coming into the last 2 weeks, we've basically been short some of the techs as we advised our clients to get out of a bit of extreme levels. We were short a few tech stocks. We have bought them all back. For this week, we expect a bit of a rally after Monday's 5% limits down on the S&P. On the short side, we still see a bit of downside for a lot of the airlines, luxury goods like your CFRs, your Burberrys. Take into account these stocks are 40% down already year to date effectively. So it's very difficult to try and sell them off here or go short these stocks here at these levels. So we are waiting for a bit of a recovery to then decide from there how we want to position ourselves. But we will generally be short luxury cruise liners like Carnival, your MSCs, and a lot of your hotel chains.
But that says to me, I mean, if you are expecting the counters that have already fallen some 40% or so to go down a bit more, that says to me that the outlook that you're taking on the global economy, probably sparked by the COVID-19 virus, is that we will continue to see a decline in tourism and people choosing not to go on holiday, and the luxury market being disturbed by Chinese consumers perhaps, staying indoors and not going into our Louis Vuitton or so stores, and the same in Hong Kong. Am I understanding you correctly? And for how long, though, if that is the case?
Yes, you are correct. That's what we are saying. So, I mean, our view is now for a 3 to 6 month period, we could experience a bit of lackluster growth throughout the year. Our concern is that global growth starts to slow at a point where we fall into recession in a lot of the economies. That can only be still accounted for once we see how bad the US is affected by this virus. So as it stands right now, I'm still waiting to see. I mean, we've just had a US earnings season that's been very good. They've had their best earnings quarter over Q4, but now we're still got to get Q1. And Q1 is where the impact's going to be. And we're only going to get that in 3 months' time. So we can only really see the impact in earnings in 3 months' time. What we're seeing right now is just an expectation. It could be driven by fear, most certainly, and it is, fear and panic, but in 3 months' time, we'll possibly have another opportunity to go short again once we start seeing how bad the earnings could have been affected.
Right. What about your view on energy stocks? We have seen them react very badly on the back of that crash in the oil price, the likes of Shell, BP globally, even Sasol here locally in South Africa. What's your view on, how much lower they can go, given the latest announcement out of Saudi Arabia that, forget 9 million barrels per pumping into the market, forget even 12. We're taking it up to 13 now.
Yeah. Look, it's very unfortunate for these companies to have been caught in crosswinds of OPEC. At the moment, they've been completely, a lot of these stocks were down 50-40% on Monday after this came out over the weekend. So there has been a slight recovery, but there has been no real recovery. Sure. We haven't seen them trading 20% higher as of yet. Only some of the companies are down 50%, recovered 20% or so. So they're still down net on net. I still do see some more downside.
Sure.
I think this war could continue, this price war in terms of oil and this production war, because we also what we have had this year is we've had the US becoming a net exporter this year for the first time, and that could they could be impacting US companies through this actual price war, and that could be a place where they strike. Like where they start striking US from an oil perspective, and they're putting a lot of the shale producers out of actual business at these prices. So I do think it can come in a bit lower. But it's still going to be over a 3 to 6 month period.
Goodness, the wars that we have been dealing with, and we're not even at the end of Q1. Trade war, tech war, now price war in the oil market. But Dylan, we are out of time. We're not at war, you and I hope. Dylan Bester, who is a director there at Skycastle Investment Group.